Sydney rents rose 6.3% in the quarter for houses. This is interesting because the Treasury modelling said that rents would only rise around 2% as a result of tax reforms. And that's the highest increase in 4 years. And yeah, this is the sort of thing that can happen in a shock.
This podcast is proudly brought to you by Pearler, the official brokerage platform of Rask. With Pearler, you can effortlessly automate your money, whether you're investing in ETFs or shares from Australia or the US stock market, whether you're a grandparent or setting up a kid's account or your own account. You can do all of that with full automation on Pearler.com. If you want to learn more, head to Pearler.com/Rask. And of course, before you invest in anything, be sure to read the legal documents like the PDS and FSG. This episode is brought to you by Stripe, helping your business be ready for whatever comes next. And the next shift in how people buy is already happening. Agentic commerce lets customers discover and purchase directly inside an AI conversation. No checkout page, no friction. 86% of the Forbes AI 50 build on Stripe. The businesses positioning themselves now are the ones who will lead this channel. Whatever comes next for your business, power it with Stripe. Learn more at stripe.com.
G'day, welcome to the Australian Property Podcast. I'm Pete Wargent from Wargent Property Buyers. I'm here with Chris Bates from the Alcove Group Mortgage Specialist. Chris, been enjoying a bit of a break this week?
Yeah, school holidays. Took the kids down Southern Highlands, sort of stayed on a river in a place called Joagja. Absolutely amazing. You know, every night we're going out and looking at wombats and kangaroos everywhere. And pretty sure I saw a platypus. It was one of those. I saw the splash. So I reckon that's a sighting, even though I didn't see anybody. But an amazing time with the kids, going away camping again this weekend. So getting through the school trenches now. 10-week sprints, and then try to have a bit of a break, and then off I go again. How have you been?
Yeah, pretty good. Yeah, I've been obviously following the Football World Cup as well, in amongst doing some work at various points in the week. So, yeah, it's been pretty interesting times in the property market. So, of course, that's what we're going to cover today in our weekly 2 cent segment. So we'll go through the big couple of property news stories this week. And then at the end, we've got your listener Q&A segment. So we've got a few of your listener questions to cover off. So, yeah, what do you think's going on in the world of property then, Chris? Obviously, a few weeks have gone under the proverbial bridge since the federal budget. Things have sort of calmed down a little bit. Now people are a bit clearer on what the future might look like under the new tax regime. And it seems like auction clearance rates stabilised and even bounced back a little bit, 7-week high last weekend. So obviously still a very, sort of subdued market out there, but maybe some clarity on the way of things going forward.
Yeah, it's been 2 months, right, since the budget. And one of the comments on one of our YouTube sort of comment section was like, yeah, you guys have been talking the same stuff for 2 months since the budget. And, I do have to admit it has been feeling a little bit like that. We have sort of, because I think as we sort of, I think how we read it though, Pete, is probably how the market's starting to read it now. I think more and more research is coming out that is sort of highlighting that it's the investor markets, the rental impact, is that some investors are going to actually sell, the idea of they're going to hold on forever. So I feel like some of the market stories starting to catch up to how we probably originally sort of read it. But it's always a funny time of year, sort of June, July. The market shuts down, like I said, school holidays, but it's going to be interesting to see what amount of new listings come on in the spring season. I personally have a bet that it's actually going to be quite dire. I think a lot of people are going to sit on their hands, particularly in the housing markets. I think you're going to see this frozen up, and in the Brisbane, the Perth, and the Adelaides, I think a lot of those people, unless they're investors selling who played in the housing market, I think the owner-occupier market's probably going to freeze up in those markets. And within sort of Sydney, Melbourne, it's probably going to be the same. I think when people are more confident about where things are going, they're going to start to like, okay, well, I want to move into a different house. But there is going to be this sort of first mover advantage. I feel it's kind of like 2018 now, Pete, in that sort of trenches, a lot of negative news back then. Maybe even the start of COVID as well, or maybe the start after the interest rate hikes in 2022. One of those periods where there's like a very heightened anxiety, but often that's the best buying. It's often when the most motivated vendors where you can actually get access to the better properties. And I think once that sort of flame gets lit, that people go, hang on a sec, I'm not going to buy any investments, but I do want to live somewhere. I do want to live in a home, and I do want to make sure it's a good asset because I can only get one asset growing tax-free. I think you'll see a bit of an upgrader boom. I also think a home reno boom. I'd say we're starting to see that more and more. If I sort of look at our applications for cash out for renovation, they've absolutely increased since budget, noticeably. And so even though there's high building costs, and people are worried about the going through the pain and the time, and the people with equity are absolutely thinking, well, if we're going to stay here, we might as well just put our extra, cash flow and borrowing capacity to a renovation. What are you saying, Pete?
Plenty of that, yeah. And in fact, if you see any bits and pieces of paint on my face and arms, that's why, because we're sort of mid-home renovation ourselves. I think... I think, definitely all of that. Yeah, definitely a lot of people are staying put. Renovations are happening. And in a lot of cases, I dare say people would be over-capitalizing given the cost of renovations at the moment. Certainly that's what we're finding, is that everything's costing more than expected, even in spite of the preceding boom in materials and trades prices. I think just take it from the macro to the micro. Well, I guess talking of stories we've been talking about on and off for a couple of months, the Iranian conflict at the time of recording, it's all back in the news again. Straits are blocked up. Oil prices jumped 9% today. So we're just recording this on Tuesday morning. Oil prices up about $7 to $78. So all of that's going on again. And I suppose just in terms of the economy, a lot of the indicators are that things are really slowing. It's interesting you said it feels like 2018 again, Chris, because one of the stories we're going to talk about today is the rental market and what's going to happen there. Because obviously this is probably the most contentious point about the federal budget changes, is it's going to screw the rental market. That was always the fear. Is it a rerun of 1985? Does it impact all the cities, or is it just a Sydney and maybe Darwin thing at the moment? So, well, anyway, it was interesting to see Nerida Conisbee on LinkedIn from Ray White saying Sydney rent rises have been in the news this week, up $50 a week in June for Sydney houses, that is. So that's over 6%, as we'll talk about in one of our main stories this week. So interesting. She just pulled some stats from NeoVal, which is a fairly new data company that's backed by Ray White. So they do market research. I'll just quote from Nerida's article. Sydney now has 161,000 active rental listings, the lowest level since December 2017. So basically 2018, as you said. But Sydney today is very different to the Sydney of 2017, with over 500,000 more people living in Greater Sydney. So it looked like with all the investor boom, we got sort of a bit of an uplift in available rentals last year. But now things have plunged and we're at 9-year lows. And I suppose, this is probably one of the big unanswered questions. We'll talk in a bit about the Domain rental report, but that's only one data point. But I guess, as you said, it's only 2 months since the federal budget. It's really too soon for that to have had any impact on rental market dynamics. But it feels to me like logically, if we're still running high immigration numbers or relatively strong immigration numbers, investors just are simply not buying. That's one thing we've certainly seen over the past 2 months is investors might be buying commercial property, or they might be looking at other options, but they're just not active in the established rental market at all now, and probably on a net basis withdrawing, with some people selling up. So where do you see the rental market going? It feels to me like it's just going to get tighter and rents are going to go up, but obviously this is probably one of the main points of debate at the moment.
Yeah, so I think a lot of people, there's been a few like housing group sort of spokespeople that have come out and said, the budget's only sort of 2 months ago, that's not really affecting the rental market. And I'd sort of argue with that. But the problem is you already had vacancy rates at ridiculously low levels, like 1% nationally, basically. I think it was 1.2 or something. A more balanced market might be sort of 2, 3, sort of 4. There's some markets with higher vacancy, and there's some markets that a lot of investors have bought in recent years. And, there's some markets where just investors have been bailing, and, particularly in sort of the capital cities. And, and there's not enough new investors to offset the amount of investors bailing. And so you are getting this sort of, pressure, and rents have gone up. I mean, they've already gone up 50% in sort of 5 years. So you can see rental affordability is already really stretched. Vacancy rates are really tight, and the rents are still going up. I mean, there's going to probably be naturally a bit of a ceiling, but there's displacement here, and I think people are more and more realizing, and I keep talking about this, the people over 50 are going to start realizing that, potentially their net wealth hopefully is in a home paid off and in superannuation, where it's going to move to a low tax environment, if not tax free, when you get over 60, depending on your age and your pension and all that sort of stuff. But I think people are going to start realizing that. And I think that story is going to start getting out. So you see a lot of people sort of banking and exiting the rental market, and then you're not enough new investors. New supply is just not going to happen. I think this is the sort of one of the real issues that have come out of the sort of budget. Two things I would think is the first-time buyers are all spooked. They all think they're going to catch a falling knife. Prices are falling. First-time buyers are the most nervous buyers out there. And I think, the sort of unintended consequence is that prices are falling and first-time buyers, well, why would I rush to buy? I've got more choice. I'm not competing with investors. I'm only going to buy this if it's a really good price. And so you find that the sort of sentiment, demand, supply imbalance is sort of pushing first-time buyers away from the market when we want them more in the market. And the second thing is that I think it's not good for the construction industry, because they need prices going up to make feasibility stack up. And then together with all the fear around, the war and, inflation and the, amount of insolvencies in the building industry, builders want to take risk right now and developers want to take risk. And so, speaking to sort of commercial finance and speaking to sort of builders, I think supply is just not going to come. I think approvals are there, all the zoning changes are there, but do they actually come out of the ground? I just don't see it happening, Pete. And so I think you're going to see this real tightening and, displacement, homelessness, need for social key worker housing is just going to increase. And people are going to get marginalised at the bottom, and that's the issue. You can get more first-time buyers in the market, great. More people out of the rental market, but who isn't getting out of the rental market? They're the ones who are going to get impacted. And I think people are starting to realise that, particularly as rents have started to go back up.
Well, there's a few people I listen to in the industry. There's the so-called talking heads, but people who actually engage with active participants in the industry. Here's a couple of quotes from this week. Louis Christopher at SQM Research, and he's been a leading sort of economic commentator, I suppose, in the housing market for as long as I can remember. I'll just quote him here. I have some strong anecdotal evidence that many Sydney projects are stalling on the ground. A large number of developers, constructors are doing it very, very tough. Many of them are geared on high lending rates. End valuations are not stacking up anymore. Cost overruns. Investors very likely to walk away on settlement. Cameron Cusher from Cusher Research said he'd seen exactly the same. And Tim Reardon, I should say, from the Housing Industry Association, essentially said, yes, since the budget, every customer type has stalled in the buying process. And a very small number of developers don't need to go to the market for finance, but a lot of them do, and they're really struggling. So, I think all of which goes back to your point, Chris, that, yes, you can get more first-time buyers into the market. Investors aren't really buying so much, and that's likely to result in a slowdown in construction. Goldman Sachs also said this week that the reverse wealth effect of falling housing prices would crash consumption in the Aussie economy and would be sort of in a per capita recession, most likely. Going forward. So, all of that going on. So, let's take a look at a couple of our big news stories this week, one of which we already touched on. So, I guess, Domain put out its quarterly rental report for the June 2026 quarter and said Sydney rents rose 6.3% in the quarter for houses. Now, this is interesting because the Treasury modelling said the rents would only rise around 2% as a result of tax reforms. Now, to be fair, some of this would obviously be pre-existing trends because the rental market, as Chris already said, was pretty tight. And that's the highest increase in 4 years. And in fact, it's nearly as big as the massive increase we saw in the tumultuous June 2008 quarter when Sydney rents rose 8% in a single quarter. So I think, this is the sort of thing that can happen in a shock. The financial crisis was a big shock, and I was living in Sydney at the time. I remember going to a corporate event, and people were just in disbelief at the increase in their rents in places like the inner west and eastern suburbs, like massive increases in the space of a few months. Now, I think there's a counterpoint here, and this is only one data point. You can certainly go and look at other data series. Like if you look at Cotality, they say rents were up 1.6% nationally in the June quarter and 5.9% over the year. But I think that one of the points is, I mean, it's too early for it to be purely about sort of supply and demand in the market. I think some of that, if those increases are sustained, must be about landlords opportunistically increasing their rents in anticipation of tighter rental markets ahead. But I suppose in any case, rents are up 40% over 5 years on Cotality's numbers. And all capital cities have got rents at record highs, said Domain. So, yeah, I mean, I guess this is a key thing in the market. With over 5 years, we've got a couple of million extra people in the country, huge amount of demand for housing. And it looks like in real time that some of that construction is now dropping away.
I think this is the other unintended consequence. So if you put your head in the mind of an investor who, has a property, yes, they've got negative gearing and they keep it because they've had it prior to the budget. But end of the day, most leases are on 1 year leases. There's some that are 2, most are on 1. Ends up to the end of the 1 year lease, and then they go to, before they'd be like, well, it doesn't really matter what my rent is really, as long as it's around market, as long as it's roughly got a decent tenant. Yeah, I could try to get an extra $5-10 a week if I really want to push it, but there's no pressure because, I've got this negative gearing. If they have an idea that they're going to sell it one day, what you want to do is have that rent as high as possible, because that it gives you the highest chance that investor could buy your property. Because new investor is going to look at it and go, well, what's the rent? What's my costs? And what's my shortfall? And I'm going to have to fund that from a negative cash. I can't offset that against my tax. And so they're really focused on that shortfall because they have to pay every single dollar of it until it goes positive. And so if you're an investor right now, you absolutely want to get the optimal rent on it, because it actually increases the value of your property in some sense, potentially, if you are going to sell it to an investor. Highly likely, probably not anyway, but a lot of investors will take that sort of view now. They'll be like, no, I'm putting my rents up. And I think that's, obviously there's a market that, has to pay it. But the reality is when you've got 1% vacancy rates and you've got 30 applications and you've got people that are desperate to move in from, who are worried about being homeless, and they're going to do everything they can. They're going to overpay the rent. They're going to be like, look, we just have to do it. We have to. And also as, leases finish, that gives the opportunity for someone to increase their rent. So it's not like there's actually this moment, there's this new lease that you have to sign. And I think you'll find that, it's kind of like, or baked in these increases, that every year there's these opportunity to increase the rents. And so I think you're going to find that. I think that the mentality of the investor is going to shift, and they're going to try to get every single dollar they can from the tenant, because they know that the rent's more important than ever, not just so much from a negative cash flow point of view, but from a sale point of view. And property managers also like to put a bit of value there. That's the reason why they can get a release fee. Look, we can increase the rent, an extra $30 a week, and there's a lease fee for that. And so, I think that you'll find that the property managers will also want that, because they don't want the investors bailing on their books as well. So the best chance of them keeping their investors is increasing the rent as well. And so, because even if they are negative cash flow right now, you have to offset it. But you still got, 6% plus interest rates, and unlikely to sort of drop in the near term. So I think a lot of investors will be struggling with their cash flow regardless, even if it is negative gearing. And so, I've said this as soon, even pre-budget and even post-budget, this has been my biggest fear. I'm absolutely not completely against all the changes, but I do think that the people who are going to get hit the hardest are the people who are in the rental market that can't afford to buy.
I want to tell you a story about how the new Rask platform came to be. In 2025, everyone was still waking up to this idea that AI was going to have an impact on the world. And it wasn't until mid to late 2025 that it really hit me like a ton of bricks. At that time, I thought, what can I do with this new tool, this innovative technology? That set in motion what has now become a totally new Rask platform, which you can find at rask.au. It is 100% free to create an account and start using tools. But what did it actually do, and what does it do for you? At Rask, we've produced thousands of podcasts. Probably 20,000 articles we've written on investing and all of these different types of things like personal finance, superannuation, you name it. So we really needed a place where we could bring all of that together for the entire community. But once we built the platform, we realized that that wasn't enough. So in 2026, we've decided to launch a new community known as the Rask Ultra community. This is the deepest, most advanced part of what we do as a business and as a community of investors and builders. We want to build a network of people that can come together and share ideas in a new ecosystem that we've built just for you. You can find out more, like I said, by Googling Rask Ultra or by creating a free account at rask.au and see if Ultra is right for you.
Well, it's similar to the commercial property mindset, isn't it? If you're going to sell a property, well, you want to get the tenants in place, you want to maximize the rent, and then you're selling the sort of the best option for the next investor. And I think, when I think back to the global financial crisis, I know you were down the South Coast or Southern Highlands this week, and like in the financial crisis, you drove down there, and every second home was for sale. It seemed at times, and I think landlords at that time, and we've had a change in tenant rights since then, but landlords saw the opportunity. Obviously, they were fearful of job losses as well, and they huge increases in rents at various points at that time because of the shock. So, we'll see how it plays out. I'll just quote from the Domain report here. Sydney recorded its largest quarterly rent increase in 4 years, with house rents up $50 to a record $850 a week. Brisbane, $20 over the quarter to a record $700 a week. And Darwin was the strongest annual growth of all, overtaking Perth as the second most expensive rental market for houses, which is quite extraordinary, but it's a kind of crazy housing market up there anyway in the territory. So look, we can all cherry pick the stats if we want to. I guess time will tell on that one, but certainly we're starting to see some noises that the rental market is becoming less affordable as those dynamics take hold. Second story this week, before we do the listener Q&A, the Bank of Mum and Dad retreats after the budget changes. So this was covered in the Australian. Loan market revealed, I quote, that the share of new homeowners entering the market with a guarantee fell from 6.4% in February to 3.9% in June. So I think, there's two things there, isn't there? One, I guess, as you already said, first home buyers are probably the twitchiest buyers in the market, but possibly, I guess, even for the parents themselves, it's a bit harder for them to potentially generate wealth in equities with the capital gains taxes, also in property themselves. And I suppose with fears about a potential downturn or maybe even a recession and the interest rates higher than they were, a lot of parents are maybe not so keen on helping their kids into the market, which has been the case, I guess, in the past year or two with the 5% deposit guarantee. So I guess, as we said, early days, but at this stage anyway, it doesn't seem that the number of first home buyers in the market is increasing. If obviously there's not so many investors around either, but it looks like first home buyer numbers are possibly dropping away.
So I think this story, and I read it, and I think it's kind of highlighting, people using sort of a family guarantee. I mean, it doesn't really make sense if you're a genuine first home buyer. I mean, it often sometimes makes sense when you've had a property, maybe you had a relationship breakdown or you had an investment property and you're not eligible for the 5% deposit schemes. But most first home buyers are eligible for that scheme, particularly since October. And so it makes sense that the guarantee scheme's falling off a cliff, because if you're a first home buyer, you'd actually try to opposite, try to get the 5% government scheme rather than put your parents under, any sort of obligation. And so parents are better off to try to give kids cash for the 5% deposit than, secure against an investment property or a home. The reality is, though, I do think that this sort of family wealth is happening. And I do think it's, particularly if you see your kids and your sort of, potentially even your grandkids having issues in the rental market, and you've got access to money, whether it's through a share portfolio, you're selling an investment property, or you've got inheritance yourself, I do think that that trend is not going to go away. That's going to be a huge part of the next decade, is the sort of the wealth transfer, particularly from the sort of baby boomers and their parents down to sort of kids and grandkids. And this sort of haves and have-nots isn't going to go away. I mean, if anything, I think the budget, all that does is encourage it further, because they're saying, well, why would I want to hold assets outside of super or my home and pay this higher CGT when I could potentially just give it to my kids or give it to my grandkids and pay off their mortgage or put it in their offset accounts? And so I think you're going to find this sort of family wealth mindset increases, whereas before they'd be like, nah, I'm just going to leave it in there. I've got a really low CGT. I can sell at some point. I could just I don't think there was this pressure. And I think a lot of people in those older ages are going to start passing it down. And I think that's one of the other unintended consequences. Actually will fast tracked the ones, the haves and the have-nots. And that problem was always a big problem. It's a societal challenge. But I do think in one element they're trying to increase, reduce the sort of inequality gap. The people with assets able to invest via companies, pay a lower CGT, make a lot of their wealth through asset gains versus income, and that's definitely the way that people have been able to get around the system. But I also think, now that they've already got the wealth, I think they're going to start giving it down for their kids to do something similar as well.
Yes, well, that all makes sense. And obviously, you guys are the coalface there in terms of lending trends. And I guess you see probably before any of us what's going on with the first home buyers. So that'll be one to watch over the year ahead. So we've probably got time for maybe a few listener questions. So do send in your questions every week. We always like to read them and cover any that we can. So here's the first one from Nervous Nelly. I'm a female, 54. I'm earning 120k a year with 550k in super and an investment property, also worth around 550k with a small remaining mortgage of 60k. My question is, when is the best time to sell the investment property? Now and put the money into super, or later after I retire? So it's positively geared around 10k a year in income, because obviously there's not much mortgage left. Thank you. So yeah, look, it's often the case with these questions. As Chris always says, you'd love to ask a few more questions to get details on where is the property, how's it been performing, what's the outlook for the local area, all of that kind of thing. I suppose just to talk in broad terms, and it's obviously not specific advice. I suppose if you were to sell after retirement, let's say you're sort of beyond the age of 60 and when your employment income has gone down, well, that's probably the better option if you're specifically thinking about minimizing tax, especially the capital gains tax. And then you could sort of move the proceeds into super if that's what you wanted to do. So I suppose the pros of selling later is basically you could pay a lower rate or effective rate of capital gains tax. And also, obviously you need specific advice on your super, but your super income is potentially often tax-free in the pension phase. I suppose the cons of doing that, well, you've got the ongoing management of the property. So a lot depends here on how's the tenancy been, if you had any vacancy issues, major repairs, that kind of thing. But you've also got the market risk. So we're currently in a market downturn, presumably, depending on where you are in the country. You've got to think about vacancies and maintenance, that kind of thing. But also potentially the property would remain in the asset test for the age pension. So yeah, you're somewhat protected, I guess, on the capital gains tax on the gains you've seen already. But then obviously going forward, we've got the changes. So I think a lot comes down to the sort of the pension and the assets test and doing some modelling there. But then also, as Chris always says, it would be great to know some more specifics about where the property is. How do you think it's going to perform over the years ahead if you're now 54 and that kind of thing? So I suppose personal risk tolerance always comes into this. But yeah, what do you think, Chris?
Yeah, I think this is going to be one of the big questions of the next few years where, if I did sort of a YouTube sort of channel that I've launched and, this isn't a plug, but these are some of the questions that I think that people will be asking. I think they'll be asking, look, is this a low yielding property? I'm making 10 grand a year on a $500,000 property. I'm not making much money. I've got to pay tax on it. I might be working for another 5-10 years. How much money am I going to make in my hand? So there's an opportunity cost there of say 500 grand that could be invested growing at sort of, 5, 6, 7%. Maybe it's low tax, maybe it's not, depending if it's in super or not. Maybe you could pay off your home loan if you've still got a mortgage. So, people are going to start realizing there's an opportunity cost of that wealth, and also protecting your retirement's getting more and more important, right? You've got 500 odd in super there, but, would you feel much better if that was $1 million, knowing that, you've got such closer to $1 million in a tax-free environment as you get sort of closer to retirement? And, are you in your house that you want to sort of retire in? Are you not? And then also I agree, Pete. I mean, the tax side, I'm personally avoiding any sort of going down the tax route on a lot of commentary. I think it's got way more complex than most people realize in recent years, and you can get yourself caught out. So you need to get really good at tax advice. That's just, that's one of the things out of the budget is the need for tax advice has gone through the roof. Also the need for planning as well, financial advice. I think that's also gone up. The reality is a lot of people can't afford financial planning advice just because of the costs, and there's only 15,000 advisors versus 25,000 advisors, 10 years ago. And they've got more work than they need, basically. And so, I think that's what you sort of really need to be doing. You need to be speaking to an advisor and getting a real sort of transition to retirement sort of strategy in place, looking at the opportunity cost. But from a property point of view, it really depends on your local market. What is the quality of your asset? Are they building more of them? Is it a small one bed or a studio apartment? I've just saw some research last week from Macquarie, and they've started to realize that the risk in the marketplace are on small apartments in high density locations. So, over 6 levels, studios and one beds are owned, 70, 80, 90% by investors. And so that's one of the markets that are the severe risk, together with, there's a realestate.com.au article that came out this week and showed that, particularly in Western Australia, some markets have gone up dramatically over the last 3 years. We're talking well over 130%, driven by investors. And so that would be another area that I would be really concerned about, is markets that have been pumped up dramatically in the last 3 years. And so, but I think this is the thing, and that's why the budget was very pro home ownership at all levels, because it's still the asset that grows tax-free, and it's pro super. It's pro putting as much money as you can into super because of the tax advantages, particularly if you're older. Hopefully that helped.
Well, the second question, thanks, Chris, is also it's somewhat related in terms of investment versus place of residence. Question from Mustang. We have 2 apartments in Sydney, both in established Art Deco blocks in Edgecliff and Mossman, nice parts of the world. We've held Edgecliff for 20 years and Mossman for nearly 10. Mossman property was bought for 1.25 million. It's worth around 1.5. Edgecliff we bought for 470k and is worth around 1.45. And we've got a place of residence which we bought for 1.45 and it's worth around 2 million, with debt of 1.2 million and 200k in offset. So here's the question. It's a bit involved there, quite a few numbers, but we're considering selling the Mossman property as the gains over the last 10 years haven't been great. I've been hesitant to sell prior to the budget as I felt we may be around the corner from price increases, but following the budget changes, I'm less confident, and holding on to this asset for another 10 years with little movement wouldn't be ideal. While the Mossman property hasn't gone up in price much or value, we are 980k and would sell for around 1.5 million. So this would allow us to put more money into our offset of our place of residence. We use the Edgecliff property as an Airbnb and my husband stays there for work frequently, so not keen to sell this property. It also has development potential with the TOD changes. I feel deflated selling an asset, but also I don't want to plod along and not consider changing strategy. So look, I suppose just on that final point, a couple of things. One is I've got some apartments in Sydney or units in Sydney myself, not dissimilar areas actually, eastern suburbs and so on. And yes, they had a tremendous run up until about maybe a decade ago, and then the past decade has been not so good. So I know exactly what you're saying, and I'm personally thinking to hold on, but I don't necessarily have a reason to sell. But I do get your point on not wanting to sell property. I'm a chartered accountant. The idea of paying capital gains tax unnecessarily, it hurts me. It's not something I like to do. But a few years ago or a couple of years ago, I had to sell a property I had in New Farm in Brisbane. Needed the money for something else, and it had a decent run. So I had to suck it up, pay the CGT, and move on. And my gut feel is I like to be a buy and hold investor. I don't like to pay capital gains tax, but the world kept turning and I just got on with my life. So from that psychological point of view, I do get your point. I think here, look, I suppose, and you have to probably take specific advice on this, but I suppose what a financial advisor would most likely say, and this is just a guess, I suppose, without speaking to any of them, but you would probably sell the Mossman property and use that equity to sort of to reduce the risk on your place of residence. If you've got the Edgecliff property, it looks, it's good cash flow, Airbnb, got development potential, so that's obviously a keeper. I guess you need to model the numbers and potentially sort of get some money into offset, and then you've got more choices of what to do with the money. So I think it's partly a psychological hurdle as to selling. But the market is not particularly strong at the moment. I don't think it will be over the next year either, most likely, given the budget changes. But you'd have to model the numbers. And obviously for the Airbnb, you've got things like legislative risk to think about, with some parts of the Waverley Council restricting the number of days per year and so on. But I guess you're across all of that. I suppose that would be the de-risking option, would be to offload the Mossman property and build up a nice buffer in offset. But what do you think, Chris?
There's a bit here. Obviously, it sounds like you're a bit older in terms of probably in your 50s. I'm just guessing. Apologies if so. Apologies. I'm just trying to piece this together because I think it matters. And the reason I sort of suggest that, I mean, you've had hedge for 20 years, and so you probably and you had another Mossman. And so is the home you're in? Your home's got quite a bit of debt on it, to be honest, like $1 million on a home. 6% interest rates. It's quite a big opportunity cost there. And, and if you are looking to stay in that, are you looking to, retire into that property? Do you think you're always going to want to, potentially also use Edgecliff as an Airbnb? I mean, how often do you use it? Does it really, do you still make enough money when you're not using it to sort of still give you a decent yield there? I mean, the ideas around the Todd there in Edgecliff, I mean, Edgecliff's going through some serious changes. And, if you've got the ability to sort of wrap that up with with your neighbours and sell it to a, particularly one of those high rises that are going to happen up near Edgecliff Station, I don't know, but that's often where you can obviously demand a huge amount versus something a bit more mid-rise. I get that. The same thing in Mossman. I mean, Mossman's going through a pretty crazy time. I mean, the council only a couple of weeks ago released their sort of version of how they want to change the Todd and the LMR rules for that sort of for Mossman, and they come up with their own plan. They voted at a sort of a council level. And how does your apartment fit within that? Does it benefit from the LMR? Is it a massive detractor? But also, not every apartment is equal. You could have a one bed in Mossman that's dark, that's on Military Road and is noisy, doesn't have parking, or you could have a 2-bed that's light, airy, in a quiet back street with parking, and and it could be away from all the LMR. And I think it's got a little garden that is communal, and so it goes from a 1-bed sort of target market that's not that strong to a 2-bed couple, downsizer, divorcee, single child families would love to live in Mossman. And so it really depends on the quality of your apartment within that and how, and how scarce it is. And if it's not one of the better ones there, I think then you might be saying, well, yeah, it's always going to be at the low end. It's always going to be sort of compromised within the suburb. What would be my alternative money for not just my borrowing capacity, but also my equity? And if I do sell, what's my next strategy? What's my alternative move? And that's when you start to weigh it up. Okay, well, I would do this or I'd do that. And then I'd read on the numbers and, and then you can say, well, yeah, actually I'd go to potentially, sell it because I think that's a better strategy. They're both around the sort of 1.5 cap, which is kind of where a lot of the first home buyer incentives finished for the 5% deposits in Sydney. And so, you might find that under that 1.5 is still getting a pretty good sort of price compared to the rest of the markets in a bit of a, concern. We are seeing that in Sydney where, properties under 1.5 are selling better than properties over 1.5. And so you might find that also benefits you. But yeah, a lot of questions around your PPOR and particularly if you sold, what would you do with the money? And if you are in your 50s, this is where the super thing comes up again. And we don't do financial advice anymore. But if I was still an advisor right now, I'd be going, hang on a sec, this is massive for the super industry and for encouraging people to put more in it. Noting there's already $4 trillion in it already. I don't see that will sort of reduce anytime soon. I think a lot of people will be putting as much as they can in.
Yeah, I dare say if it's an Art Deco apartment at 1.5, it's probably a half decent property, you would think so. But there's some good points you made there, Chris. So okay, well, let's finish with one more question from Hopeless Investor. Hi there, long time listener here. I was planning to buy property inside my super fund and then the budget happened. Is that option dead now? Well, yeah, the option isn't completely dead, but if you want to borrow for residential property in your super, well, that is now very much a restricted option. And I did see a flurry of buyers agents in the social media, in the sort of immediate aftermath of the budget, saying, you've got a very short window, use your pre-approval, we'll help you find a super fund property. And yeah, I mean, I guess that's one way to go about it. But one thing I would just caution is that you could easily get trapped on some very unfavorable terms as lenders exit the space. We did see that during the Banking Royal Commission. But for new investors, for residential property, that's not really an option. Now, commercial property still is, if that's something you want to look at, with all of the usual caveats and disclaimers around sort of a specific risk and lack of diversification. So it is still an option for commercial, but not really for resi. Chris, I know you're not a big fan anyway of borrowing in self-managed super for resi. So I guess I can preempt what you're going to say, I think.
Look, I was never completely against it. I just wanted it had to be in a really strong financial position to consider it. And, the amount you could borrow for a long time wasn't that much. But then as concessional caps went up and non-banks came in over the last few years, you did sort of start to see this opportunity for people with big balances and, particularly when you knew that they were going to contribute the full concessional contributions for a couple, it started to potentially become an option. But the prices of properties are way up since, over the last sort of 5 to sort of 7 years. And so the entry levels to good assets, particularly when it's your super and, you want to be holding it for sort of 10, 20 years, and know that you're not punting your retirement on some, short-term play. You want to know that when you, sell it one day in your retirement, that you've got a really good asset and you don't have to sleep at night factor. And so, that was always pre-budget. But, you can see this policies come out in the last few weeks. And like you say, Pete, everyone's in uproar. How could it possibly happen? I just think you have to be oblivious to what's been spoken about for almost a decade from all these reviews to suggest that it wasn't a good idea. And, the behaviour of sort of people trying to push this strategy since budget just highlighted why it wasn't. But then even when they've made the announcement, they just sort of doubled down on it and said, look, I've got 45 days. I can help you make this happen. But it was actually the worst buying time. You've got listings in the middle of winter, as if you're going to be, and all the good stuff would have sold in sort of May, sort of June time. And all of a sudden now you want to go and punt it at the worst time when the littlest of supply on the market just to get in. I just thought it was, pretty poor that people were pushing that. I think it's really not been good for the property industry and the mortgage industry in the last few months. I don't think they've been behaving very well. They've almost just sort of proven to the government that they can't be, that they can't be trusted, really. I just don't think they've done a very good job at representing themselves as trusted advisors and looking out for their clients' best interest. They've jumped on fear, content, and, it's not been good. And so that would be my take, Pete. I, like you, Pete, thought it was a bit ridiculous how they've been behaving once the announcement came out.
Well, I will say this. I guess, somebody's been in the property industry for a long time. Yes, the tax changes are going to be painful to a certain degree, but it's not all downside, is it? I think there's been some crazy stuff going on in the industry over particularly the past 5 or 6 years when it's been building for a time, but just the lack of oversight, the lack of sort of due diligence in a lot of cases. We've talked about this many times on the podcast. Well, a lot of that was due for a clear out and now we're getting it. So yes, it could be a painful adjustment and some businesses will go by the wayside, but there's a decent argument to say changes were needed. So that's the environment we're in. So that's about all we've got time for this week. Chris, thanks for all your insights as always. Do send us your listener questions if you want to have a chat with Chris or his team. Just follow the link, and likewise, if you've got property buying questions, always happy to have a chat. So shoot us a note. Chris, any plans for the week ahead?
No. Actually going camping up in Laguna. So up in sort of the Hawkesbury area, staying a bit of a teepee there with the kids for a night, just to give them a break before the school holidays finishes next week. But what about yourself?
Oh, just World Cup fever here. So, but I guess by the time this goes to air, I guess it will be Sunday. So, we'll all be wrapping up. But it's been a great tournament, really exciting, and kids have been really getting into it. So, I'll probably get withdrawals at the end of the tournament, but it's been great fun. Have a great weekend, everyone. Thanks for tuning in, and look forward to seeing you on the next one.
It's coming home, Pete. It's coming home.
Hopefully. We'll see. Cheers.
I regret to inform you that chances are a lot of you will need financial advice. Since we started the Rask Advice business, I've noticed quite a few trends, but one of them is the importance of having confidence in what you're actually saving towards or investing towards. A lot of people in the Rask community are very capable of managing their own money, but when it comes to critical points in their life, like retirement, selling a business, scaling a business, getting married, buying your first home, so on and so forth, getting expert advice will actually save you from a bunch of mistakes and give you the confidence to know what it is you're doing and why you're doing it. If you want to get matched with one of the trusted financial partners that we have, you can just head to rask.au/financial planning, or you can get in contact with us on any of the Rask websites. Not only does Rask itself provide financial advice, but we also have trusted partners if we're not the right fit for you, so we can help guide you in the right direction. And that in turn supports us to create more free financial education content like podcasts, courses, and so much more. Thanks for watching this episode of the podcast. If you want to hear more from us, you can get daily videos and podcasts on Rask's YouTube channel, or if you want to enroll in a free course on investing, property, business, money, you name it, you can join over 34,000 other students and enroll in a free course on the Rask website. Simply head to www.rask.com.au and follow the prompts. Thanks for watching this Rask podcast.